So this is actually our first draft and first presentation of this paper. So this paper is on local resilience. So basically, the motivation of this paper came from, or is best summarized by a statement in Holmstrom and Shuo's book in 2011. So basically, they were talking. This book was written after the most recent financial crisis, and they were talking about the optimal channel for the government to use in distributing liquidity. And then they think this is a serious, an issue with, that deserves serious attention. And our paper is trying to address this problem with the approach by approaching this problem by examining the SBA, the Small Business and Administration Lending Program. So specifically, in the US, as Tyrell said, it is reasonable to consider banks and other intermediaries as the natural channels to distribute government liquidity. And what's happening in reality in the US is those programs, the subsidized bank lending programs, are actually going through banks. And they target firms mostly instead of households directly. So we're interested in looking at what is the ultimate impact of such lending on the resilience of local labor markets to negative real shocks? And does local bank capitalization play a role in this, in determining this ultimate impact? So more formally, we're asking two questions in this paper. The first one is, how would the dependence on subsidized bank financing, in our case is the Small Business Administration Program, affect local labor markets' resilience to negative real shocks? And does the impact vary according to the type of labor and the amount of local bank capital? So the setting we're using is the recent or still ongoing pandemic, the COVID-19 pandemic, that is a real shock, a direct shock to the real sector. And you might be wondering, like, which came first? Like, the setting came first and we came up with a paper responding to the setting, or we have this idea? So it's a mixture. So we have a vague intuition or idea where we are interested in looking at small business lending and whether banks are efficiently channeling the funds from the government to the real sector. And this COVID pandemic is just a suitable setting, we think, for us to actually carry out some tests, which is how this paper originated. So speaking of the setting, there are important dates that we want to emphasize. The first date is the US National Emergency Declaration for the pandemic, which was on March the 13th. And then there's issuance of social distancing guideline at the national level following that 3 days later. So we're using the week starting from March the 15th as the first post-event week. So we're conducting most of our analysis on the weekly level. So just to give you a further sense on the magnitude, if you're not already aware of it, the magnitude of this impact of COVID-19 on the labor market. This is the US national unemployment rate at the weekly frequency, data offered by BLS. We can see that after the March 15th, the first week post-event week, the unemployment rate increased significantly, and it dropped slightly in early May, probably due to like reopening of businesses, but at least from till the end of our sample period, the impact seems to be persistent. So our roadmap, or our actual empirical design, is as follows. We're going to compare two types of counties as our main test. The counties are categorized according to how much the local jobs rely on Small Business Administration Program. So basically, we define the reliance using the proportion of local jobs supported by SBA bank loans. I'm going to elaborate on this definition soon when I talk about data. And then the real outcome we are examining will be at various levels, at the county level, establishment level, and also individual employee level. And I'm going to talk about how our data can offer this granularity. And we are also looking at how the outcome differs according to local bank capitalization. And finally, we use the Paycheck Protection Program, how much banks are lending through the Paycheck Protection Program that was carried out as a response to this COVID-19 pandemic to mitigate real consequences, and how bank capital ratio is affecting the process of Paycheck Protection Program lending, or in short, PPP lending. And before I go into details, this is a summary, quick summary of our main findings. So we found that counties with high reliance on SBA lending ex ante in 2019, before the pandemic, experienced worse impact. So they had more job losses, they had more business closures, and the losses were mainly borne by lower income workers. And if the area has also low amount of local capital, bank capital, then the impact is amplified. And for the PPP lending, we found that counties with less capitalized bank sector actually received disproportionately less PPP funding. So these are our main findings. If you went through the paper, you'll realize that there's a model in the paper. So because we only have 30 minutes, I'm gonna omit the model and focus on the empirics. So the first thing I would like to introduce is the main data we're using, which is probably new to you, or to most of you. It's called the Homebase data. So Homebase is an app. It's basically employee scheduling app primarily used by small businesses in the US. Is pretty new, actually. It didn't exist for long. And the good thing, the first advantage of that data is the granularity. So it has, this diagram gives you a sense of the data structure. Each box represents a table, a data table. So basically they record all the users. Each user is an employee. They don't have the employee name, of course, but they have the user ID. So we can track individual employees using this data at high frequency because they report everything on a daily basis. And we aggregate stuff to the weekly frequency to conduct our analysis. And then they also have the companies these employees work for, including the company's industry or business type, and the job nature, including the wage, and time cards, which records the work hours. So, and arrows here represent how different data tables are linked. So this, again, this diagram is to give you a sense of how granular the data set is. And the second advantage of the data is relevance for our empirical setting. So as Chetty, so this paper by Chetty and co-authors, which is actually how we came to know this Homebase data. This Homebase app is used by employees who earn lower wage rates on average compared to their industry corresponding averages. And the usage or the coverage of the data is concentrated in sectors that are most adversely affected by COVID, for example, retail and hospitality. So for our setting, for our purpose to look at impact of the COVID pandemic shock, the Homebase data is the most arguably very relevant or suitable to look into. So there might be concern about external validity thing, but as for our purpose, for us to say anything, to find any result, we think that Homebase data is the way to go, given its granularity and given its relevance for the shock. And the sample period we're using is from December last year to early July, first week, 2020, at weekly frequency, as I mentioned. And I mentioned that we also look at business closures, which is not directly reported by Homebase. So we define business closures using like the number of businesses that remain open. So we assume an establishment of a business is open if at least one employee clocked in during a week. So we wouldn't categorize it as closed if no employee clocked in for a particular day. But if no employee clocked in for the entire week for an establishment, we say is probably closed. And then we calculate the total number of open businesses for 1 million per million population for each county. That's how we, so this is how we defined our main outcome variables. And the data source for our categorization of counties, which is the SBA bank lending, we collected loan level data on the two most common normal time programs, SBA lending programs, to measure local reliance. And the way, as I said in the introduction, we define this reliance according to the number of jobs created and retained by each loan. So these numbers are directly reported in the loan data. It's not what we calculated. And we use the BLS monthly county level unemployment and labor force data as well, because we need a denominator for total labor force in our definition of this percentage of SBA jobs supported. And we calculate this measure based on data in 2019, so pre-pandemic. And we finally define an indicator that we use in the regressions. A high SBA indicator is saying this county is more relying on SBA finance jobs. So there are some additional controls, additional data sources we want to point out where we defined or calculated our control variables. Because it's a unique setting, the COVID setting is, we have to control for public health impact, we have to control for demographics and local industry level employment. So those are pretty standard. One thing that is rather unique or a little bit less common is the vulnerability to social distancing. This is unique to our setting, which we think is important. And this came from a paper where they defined at the industry level an indicator that will be equal to 1 if the industry is not conducive to remote work. So we borrowed this definition from the paper and used this vulnerability to social distancing as an additional important control for our results. Because we have to control, by comparing counties of high and low SB reliance, we will have to control for county characteristics that might contaminate our empirical results. And this is one thing that is important. So this table gives you our first result, or one of the main results. These regressions are run at the monthly level because BLS only reports county level unemployment rates at the monthly frequency. We're regressing unemployment at the county level to a post indicator interacted by the high SBA indicator. So in other words, this is similar to a diff and diff setting. And column 1 and column 3 give you estimations without controls. And column 2 and column 4 gives you the results with controls. We are controlling for demographics, and these, by demographic controls, we also include county level personal income. And these two controls we listed here are unique to the social distancing or COVID setting. This vulnerability, percentage of employment that is vulnerable to social distancing, this is from this measure I talked about. And also we control for the cumulative deaths per 100K population before the event date, before March 15th, because we want to control for the awareness of local population or just another aspect of county level characteristics that is related to the pandemic. And overall impact, this 0.514 means the high SBA counties on average had 0.5 percentage points more increase in unemployment rate at the monthly frequency. And this graph gives you a sense of the dynamic DID, and we are comfortable that there doesn't seem to be a pre-trend. And then if we look at the shaded area represents the 95% confidence interval. And if we look at the impact on a time series, it seems that the impact is rather quick and persistent. So that is the first result we are we had, which is on unemployment at monthly frequency. For all other analysis, we are running regressions at the weekly frequency. So this second main result is on business closure. So open is defined as the number of businesses that are open per million population. The first column gives you the estimation of the entire sample, so all industries. So on average, the high SBA counties closed 11 more businesses compared to low SBA counties after the pandemic shock. And column 2 through column 5 gives you the estimation for different subcategories for different industries. So entertainment, food and drink, professional service, and all other industries. So in case you're wondering why the coefficients of these coefficients are very different from this coefficient, these should actually add up to this entire estimation because we're using we define the y variable according to per million population. And then so basically the subcategories the effect should be adding up to the total impact instead of having similar coefficient estimates, just in case if you're wondering about that. So as probably we anticipated, the impact is significant for entertainment industry and food and drink. As I said, retail and hospitality are among the most shocked industries by COVID. And again, we also plot the dynamic DID for this business closure result. And there doesn't seem to be a pre-trend again. And what is different from the unemployment result is that there seems to be a reversion after early May, presumably because a lot of states in the United States started reopening businesses in early May. And so the result is significant in this from late March to late April, but reversed a little bit, or until the end of May is almost became insignificant according to the dynamic DID. And this number is the overall impact, so the average of the post period. So as a quick summary, at the county level, we had two main results. One is the high SBA counties, on average, closed had more unemployment rate increase and closed more businesses. And the differential impact on unemployment rate persisted, whereas the impact on business closures seemed to be diminishing after early May, after states restarted their businesses. So this is the county level results are to establish sort of the basis for our analysis, and we then examine more specific labor market outcome by looking at establishment level labor input. At the establishment level, we examine 4 outcome variables mainly. The total clock-in hours for the establishment by their employees, number of employees, wage expense, total wage expense for the establishment, and the percentage of non-managers, so ordinary, regular employees. And we found significant differential impact of the pandemic on high versus low SBA counties for all 4 outcome variables after controlling for cumulative death and vulnerability to social distancing and demographics. And also we included establishment level and week level fixed effects. So to graphically show you this, one thing I want to point out, or we want to emphasize, is that the establishment level outcome, except for the share of non-manager workers, well, also pretty persistent, but less obvious than these 3 results. So the weekly hours, number of employees, and weekly wage expense, all the 3 impacts seems to be persistent. So although we had business closures, where we also use the home-based data, we had the business closure results sort of reversed after early May. We are not seeing the same reversion for these outcome variables we examine at the establishment level. So that is one thing we want to point out. It seems that the differential impact on the labor market, like establishment level labor input, persisted for high versus low SBA counties. So again, as a quick summary, we at the establishment level for the total number of hours clocked in, number of employees, and wage expense and the percentage of non-managers, we observed significant differential impact of the pandemic on high versus low SBA counties for all outcome variables. And then that gives us the ground to further examine whether this impact we identified that is persistent at the establishment level is reflected, or how it is reflected at the individual worker level. So that is our next set of results. So for high versus low SBA reliance, we do, for the individual worker level, we do wage and hours. So if we are running regressions on log wages at the individual level, wage and hours are both for intensive margin. So these regressions are run using the employees that did not get unemployed or did not go on hiatus. So for the intensive margin, we found a more decrease in the high SBA counties in wages and in hours clocked in. And the effect is concentrated among non-managers or within the home-based data coverage, the lower income workers. And for the dynamic DID plot, again, we're observing the effect, the persistent effect at the individual worker level for non-managers, but not necessarily for managers, which is consistent with what the regression is telling you. And then for the extensive margin, so those regressions are run again by examining only those workers that stayed with their employment. For the workers that might have gone on hiatus or temporarily stopped working, we look at how likely each worker is going to go on hiatus. For both all employees, non-managers and managers. So this is the extensive margin at the individual level. And we found that high SBA counties compared to lower SBA counties have more overall employees, higher likelihood of employees going on hiatus. And it is most significant for non-managers, but also marginally significant for managers. And this number here, the y-axis here, hiatus indicator, this means on average in higher SBA reliance counties, the likelihood of hiatus for non-managers is around 2.5% higher. And this is significant and persistent, but it's not the same for managers. So the effect exists for individual workers, but is concentrated among non-managers or lower income workers in the home-based data. So to summarize, we have identified a persistent labor market result, differential impact of the pandemic on counties that are relying on SBA programs high versus low. And then the real losses embedded in the inferior resilience of the high SBA counties seems to be borne mostly by lower income workers. And this is pronounced, where this effect is significant at both the establishment level and individual level. And at the individual level, both in terms of intensive margin and extensive margin. So that established our results for the labor market outcome. And for the last piece of this empirical exercise or this presentation, we would like to see whether we can attribute this distributional effect we observed in the labor market to local bank capitalization. As the government aid program, one of the main ones, PPP for the COVID pandemic, predominantly is channeled through banks. So in order to look at local bank capitalization, we have to define local bank capital ratio. So we're defining that ratio using the bank. So we identify each bank branch first. And for that branch, we identify like how many branches are in the county and what is the proportion of these branches as the total number of branches nationwide for that same bank. And then we multiply that ratio to the national level, to the consolidated bank level capital ratio. So for each branch, we define the capital ratio using that, and then we do an average across all branches in the same county. So that is how we capture local bank capitalization. And also, so that is the X. For the outcome variable, we would like to see how much PPP funding was actually carried out at the county level. So we use actual PPP lending data we acquired at the loan level, which is the number of PPP loans, total dollar amount, and the number of jobs retained by these loans in each county. And we divide it by the potential borrowers, or potential borrowers, which is the ex-ante, like the demand for PPP loans. We use the number of unique borrowers from SBA lending programs, again, in our previous data for each county in 2019. So this measure is trying to capture how much PPP funding demand was satisfied at the local level by local banks, and how this might respond to, how might be different according to the local bank capitalization. So our first result is actually not using the PPP, but we run a triple difference first for our previous unemployment and business openings as outcome variables. And we found that results are like bank capital overall is amplifying this result we identified previously. So basically counties with higher SBA reliance, if the county also happened to be having lower bank capitalization, the effect is amplified or is more significant. And for the PPP lending, because of the time, I'm going to skip this graph and give you the regressions directly. For the PPP lending for the ordinary B square, we're having this result as the higher the capital ratio of local banks, the more likely or the higher proportion of PPP lending demand will be satisfied by the banks in terms of all three outcomes: the number of loans, loan amount, and the number of jobs retained because of these loans. So, but it's obvious that there's endogeneity concern for the local bank capitalization. And for that, the first concern is that the severity of regional demand shocks might be proxied by the local bank capitalization. And that severity would also impact local businesses. So that logic would actually go against our positive correlation, the positive correlation we have shown between PPP funding and capital ratio. So we're mainly trying to address the second concern, which is higher local bank capitalization could reflect better ability for firms to get access to other kind of loans, non-government subsidized bank credit. And that will result in lower demand for the subsidized bank credit. So we construct an instrument. So because I'm running out of time, I'm not going to go through the details. The intuition of the instrument is we are trying to capture variations in the local bank capitalization that is not rooted in the local county. That will come from other counties. So basically that will come from the banks that would operate in the county we're interested in, and also operating counties in other parts of the nation. And then whether those other counties, how much of those other counties' unemployment changes would have affected the local capital ratio of our target county. And then we did a two-stage least square regression to addressed the endogeneity concern, and most of our results persisted. We had significant results mostly for number of loans and loan amount, and the results is slightly weakened, but still significant for the number of jobs retained. So overall, these bank level results or bank capitalization results is telling us that the subsidized bank lending impact or the differential impact of COVID shock, according to how much locally how much local jobs are supported by the bank subsidized bank lending, could be attributed to the bank local capitalization. So higher bank capital locally would have the local counties would experience better resilience, and due to presumably banks' better willingness to carry out government aid programs. So that would summarize our main empirical exercise. And if you're interested, you can. There's also a model which I think, thanks to Emilio for the comment, the model now is not probably a bit distant from the main setting of the empirics. So if you have any comments for the model, you're also welcome to post those in Slack, and Erica and I will be happy to discuss that with you. And so this pretty much is what I wanted to include in the presentation, and thanks everybody for your time.